We'll go to the chapter review question for chapter 5 on books of original entry. So the first question says, choose the correct phrase to complete each sentence. Purchase of space is recorded in the purchase journal. When we talk about purchases journal, we're talking about that book that you open because you have purchased or you have bought some goods from a credit supplier. That's why you open a purchases journal. So what would you record there? You said goods for cash, goods for credit, machinery for credit, stationery for cash. Because we said it's a journal. A journal will mean that we have bought some goods on credit. So the answer is B. You get it? So purchases of goods for credit is recorded in the purchases journal. I think that is clear. We go to the second question. We post the total of the discount recorded on the debit side of the cash book in the cash book. We have, here we're talking about the 3-column cash book. On the debit side of the 3-column cash book, we have the date, the details, the folio, discount allowed on the debit side, then cash bank. On the credit side, we have discount received. Right. So here the question is saying, what are we going to post? Which discount are we posting on the debit side of the cash book? It is discount allowed, debit discount allowed. I think it's clear. C. Then the third question, they said, credit notes are recorded in the credit notes. When you have a credit note, you would have gotten a credit note because the customer is returning some of the goods we sold to him or her. Do you get it? So credit notes will be recorded in where? In the sales returns. So credit notes are recorded in the what? Sales returns journal. Do you get it?
Yes.
All right. So we record it in the sales returns journal. Sales returns are goods that customers are returning. Why do we issue a credit note? We are issuing a credit note to notify the customer that the invoice has now been deducted. Because the customer is a credit customer, right? He bought from us on credit. So he's returning certain goods, maybe because the goods are more, or probably because they are expired or damaged. So these are the reasons why a customer will be returning goods. So if the customer is returning it, the customer would have issued a debit note to return it. So it's for we supplier to issue a credit note stating that the invoice has now been deducted from the value of the returned goods. Is it clear?
Yes.
So that's why it's going to be recorded in the sales returns journal. Then we'll go to question 4. For question 4, they said, irrecoverable debts are written off in the... So when we talk about irrecoverable debts, we're talking about debts that have gone bad. That means the credit customer won't be able to pay. So that's an irrecoverable debt. Do you understand?
Yes.
The credit customer will not be able to pay back. That is irrecoverable debt. So irrecoverable debt means that we have sold to a customer, to a debtor that would not be able to pay. Maybe because the debtor has been officially bankrupted. Like he doesn't even have asset anymore. So where do you record it? You record it in your sales book, because it is through your sales book that you have sold to the customer on credit. So it will be recorded in your sales book.
Yes.
So we have double entry transactions there. You debit the bad debt and you credit the account receivable. The double entry for irrecoverable debts, we're going to have double entry for that transaction. So the irrecoverable debt, the double entry will be the bad debt. We're going to open a bad debt account. Bad debt account will have a debit entry, and that account, the customer's account that is unable to pay back, will be credited. So you debit bad debt and you credit trade receivables or account receivables. That's the double entry for irrecoverable debts. I think it's clear. We talked about irrecoverable debt, and we're talking about the double entry for irrecoverable debt. The double entry is bad debt to be credited, debited, and accounts receivable. That's the account of that customer that is not paid, that the debt has gone bad, will be credited. Is it clear? We'll go to question 5. Are you there? Yeah, they said entries in the purchases day book are made from these invoices but not just an invoice. Here they said they wrote credit notes, delivery notes, petty cash voucher. Let me quickly explain these ones. Credit notes, we said it already. This is a document, a document from the supplier notifying the credit customer that certain amount has been deducted from its invoice. Delivery notes is the item. This is a document. It's an item, that combination of all items that you've purchased from your supplier. That's the delivery note. It is always given when the products or the goods are to be delivered to your premises. So whatever you bought, the delivery van will bring it. As soon as the delivery van brings it, you have to sign on the delivery note that all those goods that the delivery van has brought or the dispatch has brought to you are okay, are in good condition. Then you sign it. So it's not to be recorded. It can be even sent through email. You can send it, your supplier can send it through email to you. So as soon as the dispatch comes in, you just have to check the quantities, the value of the quantities, and the figure, and whatever you need to check, you check. Do you get that? Then for petty cash voucher, we use petty cash voucher to disburse little cash or small amounts of money in the business. Those amount of money for maybe expenses on stationery, expenses on transportation. These ones you don't have to go to the bank to get them. That's why we open petty cash voucher. So that's not it. Then the answer is invoices. But when you talk about the invoices here, we're talking about supplier's invoice. Do you understand? You purchased, yes, but it is from the supplier. So the supplier would have issued an invoice to you. Then that is what you use in recording the purchases daybook. Is it clear?
Yes.
Okay, so that the answer is C. Then we'll go to question 6. They said, name the business source documents used to prepare the purchases daybook. It's just the same as question 5. So it is the invoice. The source document is an invoice. Is it clear?
Yes.
Then we'll go to question 7. It said, name the source document used to prepare the sales returns daybook. Yes, sales returns daybook. You would only be able to prepare a sales returns daybook if the credit customer has returned certain products to you. Then you would do that using your credit notes. You know, we said the supplier will issue a credit note notifying the credit customer that certain amount of money has been deducted from his or her invoice. So that means the source document for a sales return daybook will be the credit note. That is the document, the source document. The first document, that means the document that you have to trace that transaction to is a credit note. Is it clear? Then number 8, they said name one use of journal. We have different uses of journal. 1, we can use journal to correct errors. 2, we can use journals for double entry transaction. We can use journal to transfer into different accounts. That means into different ledgers. When you're preparing different ledgers, you can use journals to prepare them. And when you are recording entries, opening the recording, like you purchase different goods on credit, your first recording can be through the journal. So these are the uses of journal. Is it clear? Great. And the last question, question 9. They said, which 2 accounts are prepared from entries in the purchases returns daybook? Purchases returns daybook is not before purchases. There are documents that will make us to say we are returning the purchases, the goods that we bought goods from a supplier. So because we have bought these goods from the supplier, the purchases return is not the first account. There are accounts before the purchases returns. What I'm saying is this: we are returning these goods because we bought them. In the course of buying them, there's an account that we have to open, which is purchases daybook. Do you get the point here? So the two accounts we need before talking about purchases returns, or before these purchases returns, are goods that we are returning to our credit customers, credit suppliers. Like, our customers are returning to us. Do you understand? They bought it from us and they are returning. That's purchases returns. So what are the documents we have to open? Which accounts are we going to open? We're going to open purchases account, purchases daybook, and purchases ledger, and we are going to open purchases ledger and general ledger. So those are the 2 accounts we open. We're going to open the purchases ledger, which is for the purchases, credit purchases. I'm going to have the general ledger, which goes with individual accounts. Is it clear? So the 2 accounts are purchases ledger and general ledger. Any question about it?
No.
So that ends chapter 5.